If you want to build wealth in 2025, stop chasing hype. Stop looking for quick wins that make you feel good today, but cost you 10 years tomorrow. Wealth is built on assets, real solid compounding assets. And I'm going to give you the 5 that matter most this year if your goal is long-term growth. Number 1, yourself. The best ROI you'll ever get is the skill sets and knowledge you build. If you can't make $1,000 today, giving you $100,000 won't fix that. Investing in coaching, books, mentorship, and experiences that expand your ability to produce income will compound for decades. Number 2, businesses. In 2025, the fastest path to wealth is ownership. Whether that's starting one, buying one, or scaling the one you have, businesses create cash flow that you control. And the more leverage you build into it, systems, people, distribution, the more valuable it becomes. Number 3, real estate, but not the emotional dream home kind. I'm talking about income-producing properties, assets that generate monthly cash and appreciate over time. Multifamily, commercial, and rental real estate still provide stable, long-term wealth in a world that's unpredictable. Number 4, equities, stocks, ETFs, index funds. Not sexy, but over time, they beat almost every other investment vehicle. The key is discipline, consistent contributions, no panic selling, and letting compounding do its job. Number 5, technology and innovation plays. We are in an era where AI, biotech, and clean energy are rewriting industries. Having a smart allocation here, whether through funds or direct investments, positions you for asymmetric upside. The trick is not to gamble, but to get exposure to the inevitable. Here's why: money follows value. If you can solve bigger problems faster and more effectively than the average person, the market rewards you with more money. But the skill of solving those problems comes from what you've invested in your own development. If you have no skills, then no investment strategy is going to save you. Let's be real. If you can't figure out how to earn $1,000 this month, what makes you think you'll know what to do with $100,000 sitting in a brokerage account? You won't. You'll burn it, you'll waste it, or you'll lose it. That's why people who win the lottery end up broke. Their level of personal development never matched the size of the money they receive. When you invest in yourself, you create leverage. Skills are leverage. Knowledge is leverage. Relationships built from learning and growing are leverage. And all of that compounds over decades. You buy a stock, you might get 7% return. If the market does well, you invest in yourself, your ability to sell, to negotiate, to lead, to market, to operate, to think strategically, and your return can be 1,000% because those skills make you money over and over again. It's not even close. But here's the part people miss. Investing in yourself isn't just about formal education. In fact, for a lot of people, formal education is the most expensive way to get the smallest return. What actually pays off is targeted, intentional investment in areas that directly move the needle on your earning capacity. That means books that actually teach you a skill, not books that just make you feel good. That means courses, coaching, or mentorship that give you frameworks you can apply immediately. That means putting yourself in rooms with people who are ahead of you so you can absorb how they think, how they operate, how they solve problems. That's worth more than any degree hanging on a wall. And it's not just skill sets. It's also mindset. Because let's be honest, most people don't fail from lack of information. They fail from lack of discipline. They can't stay consistent. They can't delay gratification. They can't push through the boring part. So if you invest in developing habits, routines, and mental toughness, that's money well spent. A gym membership that teaches you discipline, a coach that holds you accountable, even therapy that helps you remove limiting beliefs. These are all investments into yourself that will return 10 times the cost because they make you more effective at everything else you do. Think about it this way. If you took every dollar you would have put into random investments in your 20s and instead spent it building your skill set, by the time you hit your 30s, you'd have the ability to generate cash on demand. You'd know how to sell, you'd know how to market, you'd know how to manage a business or negotiate a deal. And then when you take that cash and put it into stocks, real estate, or other assets, you're doing it from a place of strength. You've built the money machine first. The mistake is thinking you can skip this step. That's why people chase passive income before they've built active income. They want to buy real estate before they've built the skills to actually generate the down payment. They want to buy into a startup or throw money at an index fund when they haven't even built the discipline to stick with a habit for 6 months. You can't outsource the work of building yourself. That's the foundation. And here's the best part. Nobody can take it away from you. The market can crash. Real estate can lose value. Businesses can fail. But if you've invested in yourself, you'll always know how to rebuild. That's security. That's freedom. That's wealth. When you've built the capacity to generate money regardless of the circumstances, you don't need to pray the market goes your way. You just adapt and keep going. So if you're thinking about the best assets to invest in this year, don't overlook the one staring back at you in the mirror. Ask yourself, What skills, if I mastered them, would change my entire financial trajectory? What relationships could I build if I put myself in the right rooms? What mental blocks do I need to break to stop playing small? Then take your money and put it there. That's not an expense. It's the single highest return investment you'll ever make. And if you actually do this, if you pour your time, money, and energy into leveling yourself up, here's the guarantee. Every other asset you touch will perform better. Your business will make more. Your investments will compound faster. Your real estate decisions will be smarter because the person managing them, you, is now more capable, more disciplined, and more valuable. That's how you build wealth that lasts. If you really want to build wealth, you need to own businesses, not just work in them, not just be part of someone else's vision. You need ownership because ownership is the only way you get leverage over your time, your money, and your future. People spend their whole lives trading hours for dollars, hoping to save enough to retire. That's not wealth, that's survival. The people who build real wealth own assets that create cash flow, whether they show up or not, and the best cash flowing asset you can own is a business. Here's the reality. If you rely on a job, your income is capped. You might be great at what you do, but there's a ceiling. Your boss decides your value. The market for employees dictates your worth. You can only sell the hours you have in a week, and eventually you run out. With a business, that cap is gone. Your income is tied to how big you can scale the problem you solve. And when you own it, you keep the upside. Now, when I say business, I'm not talking about some glamorous startup idea that requires millions in funding before it makes a dime. I'm talking about solving a real problem that people will pay for today. Plumbing, gyms, marketing agencies, SaaS, real estate management, coaching. Pick the lane that aligns with your skill set and solve the problem better than anyone else. If you do that, you'll never be broke. And if you learn how to systemize and scale it, you'll never be capped. Here's what ownership does. It gives you leverage. When you own the business, you can hire people. You can delegate tasks that would normally eat up your day. You can put systems in place that run whether you're there or not. That's the first level of freedom. Your income is no longer tied to your presence. But beyond that, ownership gives you equity. Equity is wealth. It's what you can sell. It's what you can borrow against. It's what makes you rich, even when the cash flow isn't huge yet. Employees don't get that, owners do. But here's the caveat. It requires work. Owning a business is not passive. It demands skill, discipline, and the willingness to solve problems every single day. That's why most people avoid it. They want easy, but easy doesn't make you rich. Hard does. And the good news is, if you've already invested in yourself, you've built the skill set to make this possible. Sales, marketing, leadership, finance. These are all tools you can sharpen and then apply inside a business to make it grow. Another path people overlook is buying existing businesses. You don't have to start from scratch. Right now, thousands of business owners are looking to retire or step away, and their businesses are profitable, but under-optimized. If you acquire one, you skip the painful early stage and step into a machine that's already producing cash. With the right systems, you can scale it even further. That's a faster route to wealth than trying to invent the next Uber from your garage. What about freedom? That's the part people romanticize. I want to work for myself. That's not the real benefit. The benefit is financial freedom, not just time freedom, because in the beginning, you'll work more than you ever did at a job. But if you build it right, you'll eventually have both. You'll have an asset that produces income, whether you're on vacation, asleep, or focusing on your next venture. That's how wealth stacks. The other upside of owning a business is the network it builds. When you're an owner, you meet other owners, you get access to opportunities you'd never see as an employee. Partnerships, acquisitions, investments, they all flow to people who control businesses. That network compounds your wealth even faster. So if you're serious about building long-term wealth, stop thinking like an employee. Stop relying on saving your way to freedom. Instead, focus on owning or building businesses that create cash flow and equity. Use the skills you've developed to scale them. And once you've got the machine producing, that's when you diversify into other assets like real estate or stocks. But it starts here. The point is simple. Ownership is leverage. Ownership is control. Ownership is wealth. You can spend your life working for someone else and hope to scrape by, or you can take control and build something that pays you for the rest of your life. The people who end up rich in 2025 and beyond are the ones who own the businesses, not the ones who just work for them. When people hear the word real estate, they think about dream homes, flipping houses, or owning something that looks impressive on Instagram. That's not what I'm talking about. I'm talking about real estate as an investment vehicle to build long-term wealth. And the difference between the two is huge. One drains your money, the other multiplies it. The house you live in is not an asset, it's a liability. You're paying the mortgage, the taxes, the maintenance. It doesn't produce cash flow, and until you sell it, it doesn't give you income. But income producing real estate, that's a wealth machine. That's what you want to own. Income producing real estate is simple. You buy property that pays you every month, and over time, it also goes up in value. That means you get paid today and you get paid tomorrow. That's the key. Stocks can give you appreciation, but they don't pay you rent every month. Businesses can give you cash flow, but they take active work. Real estate, when done right, gives you cash flow, tax advantages, and long-term appreciation all in one. That's why it's one of the best assets to build wealth. Let's talk about the cash flow first. When you own a rental property, whether it's a single family home, a small apartment building, or commercial real estate, you get tenants who pay you monthly. That rent covers the mortgage, the expenses, and ideally leaves you with profit every month. That profit is your cash flow. The goal is to buy properties where the rent more than covers the cost of owning it. This is where discipline matters. Too many people get emotional about the property. Oh, it's a nice neighborhood, or I like the kitchen. That's irrelevant. You're not living there. This is an investment. The only thing that matters is the numbers. If the property generates consistent positive cash flow, it's an asset worth owning. If not, it's a liability dressed up as an investment. Now let's look at appreciation. Over time, real estate values tend to go up. Not always immediately, not always evenly, but historically, they rise. That means the property you bought for $200,000 today might be worth $300,000 10 years from now. Another advantage people don't talk about enough is taxes. Real estate investors get some of the best tax breaks available. Depreciation lets you write off part of the property's value every year, even if it's actually going up in worth. Now, let's be real. Real estate is not without its challenges. Tenants can be difficult, properties require maintenance, markets go up and down, but if you approach it like a business, not a hobby, you can manage those risks. You hire property managers, you screen tenants properly, you keep reserves for repairs, you don't buy in markets that are purely speculative, you buy where the fundamentals make sense. Strong job growth, demand for housing, limited supply. It's not rocket science, it's discipline. The biggest mistake people make is chasing appreciation instead of cash flow. They buy a property in a hot market thinking the value will skyrocket, but the rent barely covers the mortgage. That's speculation, it's gambling. And when the market turns, they're stuck with a property bleeding money. The smart play is to focus on properties that cash flow from day one. If the property makes you money today, any appreciation later is just icing on the cake. That's how you stay safe and wealthy long term. The other mistake is thinking too small. One rental property won't change your life. It's a start, but the goal is to build a portfolio. Think in terms of 10, 20, 50 units. Each one is a brick in your wealth wall. Over time, those bricks turn into a fortress. And the sooner you start stacking, the faster you build. What makes real estate powerful is that it creates stability in your wealth strategy. Businesses can grow fast, but they can also fail. Stocks can crash overnight. Real estate, when bought smart, is steady. People will always need a place to live. Businesses will always need places to operate. That demand doesn't go away. And that's why real estate belongs in any serious wealth building plan. So if you want to build wealth in 2025 and beyond, don't just think about stocks or businesses. Start thinking about assets that pay you every single month and appreciate over time. Learn to analyze deals, learn to manage properties, or hire people who can. Stop thinking of real estate as a dream home and start seeing it for what it really is. One of the most reliable, scalable, and proven wealth building tools available. Done right, it's not just an investment, it's a legacy. Equities are boring, and that's exactly why they work. Most people overlook them because they don't feel exciting. They don't give you the adrenaline hit of starting a business or the bragging rights of buying a building. But if your goal is long-term wealth, equities, stocks, ETFs, and index funds are one of the most reliable tools you have. The people who get rich and stay rich understand this. They don't put all their eggs in the sexy baskets. They put a consistent portion of their wealth into equities and let compounding do its job. Here's the truth. Over decades, equities outperform almost every other asset class. Not in any given week, not in any given year, but across a lifetime. The S&P 500 has returned around 10% annually on average for nearly a century. That includes wars, recessions, crashes, pandemics, everything. Businesses come and go, governments change, but the stock market over the long term trends up. That's why people who play the long game win. The problem is most people don't play the long game. They want to time the market. They want to buy when it's hot and sell when it's scary. That's how you lose. The people who win in equities are the ones who are disciplined enough to stay consistent regardless of what's happening. They invest every month through the highs and the lows, and they don't sell when the market dips. They understand that volatility is temporary, but compounding is forever. Let's break that down. Imagine you invest $1,000 a month into an index fund that averages 10% per year. After 10 years, you'd have over $200,000. After 20 years, over $600,000. After 30 years, nearly $2 million. And that's just from being consistent. You didn't pick stocks. You didn't trade. You didn't gamble. You just showed up and let compounding work. That's the magic of equities. They don't require you to be a genius. They require you to be consistent. Now, there are different ways to play in equities. You can buy individual stocks, which means you're betting on specific companies. You can buy ETFs, which are collections of stocks that track a certain theme, like technology or clean energy. Or you can buy index funds, which simply mirror the performance of the entire market. The average person will do best with index funds because you're not relying on your ability to predict the future. You're betting on the overall growth of the economy, which has historically always gone up. But here's the key. Equities are not a get-rich-quick play. They are a get-rich-slow play, and most people can't handle slow. They want the dopamine rush of big wins. That's why they chase crypto, meme stocks, or speculative plays. And maybe they win once, but over time they lose. Meanwhile, the boring person who quietly put money into index funds every month for 30 years ends up a millionaire. That's the difference between hype and discipline. Another point people miss is that equities give you liquidity. If you own real estate, selling it takes time. If you own a business, selling it takes years. But with equities, you can sell and access cash in minutes. That doesn't mean you should, it just means you have flexibility. And let's not forget dividends. Many companies pay out a portion of their profits to shareholders every quarter. That's income. It's not huge in the beginning, but over time, with reinvestment, dividends compound your returns even faster. Imagine owning shares in a company that pays you simply because you hold them. That's money working for you without you lifting a finger. Now, are equities risk-free? No, markets crash, recessions happen. If you panic and sell during a downturn, you lock in losses. That's why mindset is everything here. You have to accept volatility as the price of admission. It's the cost you pay for long-term growth. If you zoom out, those crashes are just small dips in an upward trend. The only people who lose are the ones who don't stick around long enough to let the trend play out. That's why the #1 rule in equities is time in the market beats timing the market. Nobody consistently times the market, right? Not the pros, not the talking heads on TV, not the guy on Twitter with stock tips. The winners are the ones who buy, hold, and keep buying. They let compounding do what it's supposed to do. Equities also pair perfectly with other investments. Your business might give you cash flow. Your real estate might give you stability. Your equities give you growth and liquidity. Together, they balance each other out. When your business hits a rough patch, your stocks are still compounding. When the market dips, your real estate is still cash flowing. That's diversification done right. So if you want to build long-term wealth, you cannot skip equities. They may not feel exciting, but they are essential. Decide how much you're going to invest each month, automate it, and then forget about it. Stop checking the price every day. Stop panicking when the market drops. Understand that wealth is built by discipline, not emotion. The irony is the boring strategy is the one that actually makes you rich. And the sooner you accept that, the sooner you'll stop wasting time chasing hype. Build your portfolio, be consistent, and let time do the heavy lifting. That's how you win with equity.